Welcome back, investors, to Ticker Time News. I'm Adam, and I missed the cues yesterday. More on that in a moment, but it really came down to undercutting Microsoft and Google. The mega caps, Jay, that they just collapsed today because of those two earnings, and then the fear of what may happen to Meta platforms, which completely came true, and what could happen to Apple and Amazon as this week continues with earnings. But first, here's the deal on Meta platforms with their earnings and their earnings call. First off, Meta's stock is down nearly 20% in the after hours due to earnings. How's it going? Glad to see you in here tonight. Absolutely. Now, as it comes to Meta's earnings with EPS and revenue, Meta did beat revenue expectations, but they missed on profits and they warned on near-term sales challenges. This isn't shaping up to be a very nice several quarters. How's it going? Glad to see all of you in here in the comments tonight. Hopefully we can have a nice discussion like we did yesterday. Now, with the revenue for Meta, this seems to be just the beginning. They are going to have cost challenges, revenue challenges, earnings challenges, moving forward. Their revenues fell by 4% to $27.71 billion. This initial reaction right here of 19 to nearly 20% down in Meta stock, this is going to show up tomorrow. So expect a little bit more pain in technology tomorrow due to Meta platforms and their earnings report. Now, if Apple can come save the day, that would help the technology sector. Let's continue. While Meta did beat expectations when it came to revenue, costs and expenses rose 19%. And so operating income fell by 46% to $5.66 billion. Moving forward with the earnings call, there are three primary areas of focus at Meta right now. Number one, the AI discovery engine that's powering their reels. That's like YouTube Shorts or even TikTok. Second, their ads and business messaging platforms. And then third, the metaverse, which right now is not a cash cow. It is, what's the opposite of that? Smashing the piggy bank and taking every cent that you can. They are spending tons of money on this metaverse thing. More on that in just a moment. There are now more than 140 billion reels being played across Facebook and Instagram daily. That is a 50% increase from 6 months ago. Meta believes that it's gaining time spent share from competitors like TikTok and YouTube Shorts, but YouTube Shorts seems to be growing too, so mainly TikTok. Now, regarding Reels monetization, Meta is choosing here to take a more than $500 million quarterly revenue headwind due to Reels growth, displacing revenue from more what would be the correct way to say this? From higher monetizing areas from within Meta platforms. So they're putting a real big gamble on Reels for the future here at the expense of higher margins and different monetizing places within Meta platforms. That's not very good either. In the short term, maybe it'll play out for them in the long term if short form video content remains king or queen, whatever you want to call it, right? But expect to get a more, maybe a more neutral revenue share across Meta platforms, maybe in the next 12 to 18 months. So it's going to take a while. And Meta is putting a lot of emphasis on Reels and their short-term or short-form video content. Monetization across Instagram and Facebook shows a combined run rate of $3 billion. Meta's, quote, click to WhatsApp, that passed a $1.5 billion run rate. and it grew more than 80% year over year. I guess that's one positive right there for Meta out of all the negative stuff. What can I say? Now, onto the metaverse. Oh man, there is a long, long, long road ahead of Meta before they can see a dime of profit from the metaverse, given that the undertaking is massive at Meta Platforms with the metaverse. And it will take a few versions of each product before they become mainstream. So how many versions are we talking here? If Meta is going to take, 3 different versions of a product before it becomes mainstream, what if it doubles? What if it takes 6 versions of that product before it comes mainstream? Or what if it doesn't become mainstream? That's a big what if there for Meta Platforms, and that's got investors running for the hills. Now, some apps may be saturated in some countries. There may even be some demographics, but overall, Meta does believe they will continue to grow from a large base. All right, Meta, the ball's in your court. Can you prove this metaverse thing to be a working prototype anytime soon? And can you get some return on investment within 5 years? I'm not so sure about that. Now, Meta did acknowledge it's behind where it should be, but Meta does believe a return to healthier revenue growth trends will start, here's the kicker, sometime next year. However, this goes with it, Meta is not clear whether the economy has stabilized just yet or when the economy may stabilize. And as we all know, the economy, it is not stable. It is slowing down. This is just a puff piece by Meta Platforms to try to stop the bleeding and the investor community from running from the company by saying that. What if 2023 is worse than we all expect? Meta Platforms is in a horrible position right now, and that's why it's down, nearly 20% in the after hours. But again, that nearly 20% in the after hours, that's going to carry over to tomorrow. That's not in today's 5.6% decline. That'll show up tomorrow. How much further will they fall tomorrow? I thought maybe the 5% decline in Microsoft and 5% decline in Alphabet yesterday in the after hours, I knew that would carry over to today, but I didn't think it would go 10% or 7%, and it did. So how much further is Meta going to fall tomorrow and pull down technology and the main indices with it? Okay. Since Meta Platforms does not know when the economy is going to stabilize, their budget or their budgeting for a somewhat conservative take on their numbers. So maybe that's a hopeful work for Meta. I don't know. I don't think it's going to work, not with the smart investors we have here. Now, on the workforce, Meta expects to end 2023, that's next year, with either the same size they are right now or a slightly smaller company than today. So that means layoffs are coming at Facebook. Layoffs are coming at Facebook, or I should say Meta Platforms, my apology. Now, the current surge in CapEx or capital expenditure is largely due to building out AI infrastructure. Meta expects CapEx to come down as a percent of revenue over the long term, although they did not state what that long term would be. 5 years, 10 years, 20 years. So we'll have to wait and see. This Meta project or this metaverse project, it is huge. It is a huge undertaking at Meta Platforms, and it is sucking up revenue left, right, and center. Now, onto advertiser size. Revenue growth from large advertisers remains a challenge at Meta Platforms? Well, smaller advertisers like the small, medium-sized businesses, they say that they're a little bit more resilient because they can throw $5, $10, at a post a couple times a month, if they have a sale going on or what you have. But the bigger corporations, they budget and spend that money and they're cutting back. And we saw that at Snap, and we saw that with Alphabet yesterday, and we saw that with Microsoft yesterday. So just more of the same when it comes to advertising dollars being taken back, not being spent. Okay, let's get to what you guys have to say here, and then I'll get into this choppy day in the market that we had. First up, in my opinion, Facebook, Snap, so-called social media was last decade innovations. Present generation is different and moving fast. Spot on. Absolutely. Absolutely. Meta planning to invest in data centers. I think it's good for AMD and NVIDIA. Of course, that would definitely be good for it. Meta, they have and they manage mostly a lot of their own infrastructure. So the data centers, right? And they're going to need more and more and more and more data centers as they grow the metaverse, because that's all in the cloud. So your thought there on that's good for AMD, NVIDIA, that I do believe that too. Absolutely. I do think social media, yeah, that was last decade's innovation. I can definitely see that. And as far as this new generation, where are they going to go? They're flocking to the TikToks, YouTube Shorts, Reels from Facebook, Instagram. They like that short form, real quick, in and out, type of video with, that short-term attention span is really, really throwing off these old school. Can we call Facebook old school? Old school social media platform. So yeah, things have got to change, and there's got to be a new innovation. Will the metaverse be it? I don't know. I don't know. If you're taking a attention span that is already short, and then you are trying to get that short attention span to put on a headset, to hop into the metaverse, to spend hours in the metaverse, I don't know that that's where they're going to go with their free time. However, their phones are glued to their hands and they're watching all this content on a small little screen. There's going to be something in between, I think, full-blown metaverse and the smartphone of today. Okay, something besides a big bulky headset that you put on to hop into the metaverse versus the cell phone of today. There's going to be an innovation of something in between that, right? Where you don't have to focus on such a big immersive place. Who knows? Maybe, I don't know what the future innovation is going to be. Could it be a chip? I know that's far out there. That's way out there thinking, but could that be where you just kind of blink your eye and you pop in and you pop back out when you want to? I don't know, but it is definitely a challenge for Meta platforms. So that's why it gave up 19.1% in the after hours, and it'll probably be worse tomorrow, unfortunately, and it's going to bring down a lot of other technology companies with it. So yeah, we've got that to contend with. All right, let's see here. Why AMD and NVIDIA up in after hours? Could it be the thought of the metaverse and needing all those data centers? I don't know exactly if that would be the reason. Let me try to pull up here my newswire and see if there's anything popping off here in the after hours. a bigger, not on a after hours type of news, but November, the month of November, and the fourth quarter in general are typically the better time of the year for semiconductor stocks. And as a matter of fact, the NASDAQ, which would bring the Qs into it, November is the best month of the year using historical data for the NASDAQ. So that's good. Now, the average return for the NASDAQ in the month of November is 3.5%. So that's a positive sign for the Qs, the NASDAQ technology, semiconductors for the month of November and Q4 in general. All right, just looking here for NVIDIA or AMD to see if we can find anything here right quick. I won't take but just a couple seconds here. I just want to look real quick, see if anything is catching. I don't see anything just yet. For a reason. I don't see anything yet, but I'll let it keep running here in the background. See if anything pops up here for NVIDIA or AMD. There were way too many earnings that came out today for me to keep track of all of them. So could it be an earnings related thing? I don't know. But I am looking. I guess I'll have to let this just run in the background to see if anything pops up here for NVIDIA. Nothing that I see here in the after hours that would suggest just that chip makers, they had some relative strength from some wide losses. You know, there's really nothing in here to suggest that there's something special happening for NVIDIA or AMD. So if you happen to know yourself, it was because Meta. Yeah, that was my very first thought with the data center conversation we just had. But that's what it could be, because that is good news for both AMD and NVIDIA. And just to throw that up here also, you mentioned it as well, just to throw it up there, give you credit for saying that, planning to invest in data centers, and that is good for AMD and NVIDIA. Is there a support at all for Meta? No, there's not, unfortunately. If we go here and look at the chart for Meta, unfortunately, there's no support. This thing can go, you know, nearly as far down as investors want to take it. As we go back, I mean, we're going back here. We're already back 2 years, going back to a third year. And I mean, Meta right now is lower than it was during the COVID March 2020 low. So that's why I'm saying there's no support here. There is absolutely no support for where Meta is going right now. And as I continue to tighten up the chart here, that green highlighted area that's kind of in the middle of the screen towards the bottom, that's the March 2020 low. Meta Platforms is way below that right now. And it is going back. Oh man, this is going back. Meta Platforms, literally, with its low right here, is going back to June of 2016. This low for Meta Platform right here goes all the way back to June of 2016. That is a long time ago. That feels like ancient, right? That is ancient time in the stock market. So with Meta sinking that low, there is no support whatsoever for Meta. This thing could literally fall as far as, again, investors want to take this. If I had to try to throw a number out there, the next area, looking at the volume shelf profile over this time period, maybe the next area where it really kind of sticks out is about $87. $87. That would be the next area where there's any type of support at all. And that it's trading at 129 right now. So $87, $88 a share. That's where the next, if you want to call it a technical support for Facebook or Meta platforms, that's where it would be. So again, there's no scenario right now for Facebook and some sort of a bottom. It can go as far as investors want to take it. Okay. So yeah, that's my all the notes that I want to cover for Facebook right there. If you guys have anything else, is it a value trap at these levels? Yes. Since there is no technical support for Meta platforms on the chart, because we're going all the way back to June 2016 pricing levels. Again, investors can take this down as far as they want to, okay? But if I did have to pick a technical point on the chart, it would be about the $87 to $88 a share. Let me just throw this up on the chart. For Meta platforms, if I had to pick a number, that's the number that I would pick. Let's see here. Let me throw this one up, kind of on the same topic here. Meta must have ruined a lot of ETFs and retirement funds today. Tomorrow will be the big day that it ruins them. Just like Microsoft and Alphabet yesterday in the after hours, dropping 5% each, they really set off the firestorm sale for the technology sector today, right? And again, I don't know if I want to use sale in that, but that was just the first thing that came up, popped into my mind here. But wow, those effects, they were not felt until today. So this 19.1% drop, you can see it's no longer on the screen here because it is now after 8 p.m. Eastern, and that's when the aftermarket shuts down and you don't have that data anymore. So that 19.1% drop in the after hours, that's going to show up in tomorrow's take on all the ETFs that hold Meta platforms. Yeah, that's going to show up tomorrow, not today. Today, it was a broad-based mega cap type growth, technology specific takedown that brought the indices down, even though there was a little bit of a bounce. With a few of them today, they sold off into the close. And Meta platforms, I don't think is going to help that situation at all tomorrow either. So you've got that to consider as well. All right. I see about Caterpillar and Walmart. We can look into those as well. I'll just throw Cat up here real quick. Caterpillar, I believe, has earnings tomorrow morning. CAT is Caterpillar's. Caterpillar, they're going to be hurt. They're going to be hurt. Whether it shows up in earnings tomorrow, probably will, because if you look at the global economy, it is slowing down. So all of those potential projects for building roads, building housing, all of this stuff, all of the building that would take place if we were in a strong economy that Caterpillar's machines are used for, then yeah, it would have a wonderful time. But that's just not the case. We're going into a slowing economy. There is going to be projects dumped left and right. We already see it in the housing market. It's going to happen on a larger scale, and Caterpillar, it'll get caught up in that, and Caterpillar will be hurt from that. Again, will that show up in tomorrow's earnings? That's yet to be seen. We'll know tomorrow. But I will say, looking at the chart here for Caterpillar, Cat's oversold. Caterpillar is oversold right now. It is way up here. The RSI is at a 71.6. That's not a good place for going into an earnings that could be rocky. That's not a place you want to be. Not at all. You don't want to be here. So I would be hands off on this tomorrow, going into their earnings. This is not a place you want to be. It got rejected on that 200-day moving average. It had a nice rally. RSI is extended. But that's not to say that once things get overextended, they can't stay overextended. But we got earnings to talk about for Caterpillar tomorrow morning. So to me, this isn't a good combination, right? With the slowing down of the economy, it's just not a good place to be for Caterpillar. Now, Walmart, on the other hand, when times get tough, WMT is the ticker symbol. When times get tough, people got to save money. Where they go shop at Walmart. Target is definitely one that would be hurt because that's not as discount as Walmart. Walmart is a place where you're going to go. You're going to try and find your best possible. Now, Walmart has been hurt with a buildup of inventory that they've been working through. But it's been on a run over the past few sessions that has it a bit on the overextended side. 70 and above is overbought. Walmart's at a 71.5. It is technically overbought. Okay. So where could it come back down to? I'm just looking here where it hit today. It closed in this little air pocket that it kind of ran up to, found resistance, and then dropped back down. So where could this come back down to after this beautiful breakout? It could probably come back down to where it broke out to. Its 50-day moving average is probably the real first test here for it. If it does pull back, which I'd assume it would. I mean, it's up there matching where it was last earnings, and I can't imagine things have gotten that much better. Prices have continued to go up. Inflation has not been dealt with yet when you're looking at core inflation. So, yeah, it is up there. Yeah, right. When it gapped up from its last earnings, that's where it was at today. So this is definitely a place of resistance here for Walmart. I'd expect this to pull back and come back down. If we're looking here Maybe this area around 134, 135 could be a support area. That's just above its 50-day moving average at 133. So that's where support, I think, could come in for Walmart. Its 20-day moving average is starting to move up there, but it's just not there yet. All right. So just real quick there on Caterpillar and Walmart. All right, let's hop over to the SPX, which is the ticker for the S&P 500, and we'll get this lined up here and pulled out of the weeds. It's interesting what took place today. It was definitely, what could I say? Today's market, today's price action, this was no place for a beginner. Okay. Beginners, it was a tough day. As we look here, as I open this chart up, the stock market, it was choppy today, to say the very least. As a matter of fact, let me go to the 5-minute time frame. You can see the chop better and how today played out. Give me one quick second. Got to push one button here to open this up. And if you guys have questions, keep them coming. I'm happy to go over them while we are going through my notes here. Look at this price action here on the screen right now. We had this rally first thing this morning. We reached our top, and then we pulled back, for the rest of the day practically. We did hit a low kind of 3 o'clock in the afternoon, and then just kind of bounced around, chopped around for the next hour or so. So again, not an easy day to trade this. You think it's going one way in the morning, and then it switches mid-morning and starts heading the other way. So not fun to mess around with. Now, one thing I will say here about the SPX and the S&P 500, it did move above its 50-day moving average this morning. And the high today was at 38.86. Its 50-day moving average is at 38.60. So from that high today of 38.86 to its close, 38.30, that was a big move, almost a percentage point for the SPX and the SPY. It was up in the green nearly 0.7% earlier this morning at today's high. And then, of course, it closed down, 0.75%. So it was up as much as it was down today. That is some serious chopping around that can catch even the best people off guard. The major averages, they were steered by price action in mega cap stocks. I've said this already on this live stream. And we got to talk about the dollar. Oh my gosh, the dollar just completely fell today. That was a big surprise for me. I did not expect that. And then for the market to react the way it did, even with the dollar being down a whole percentage point, that was kind of shocking. It just goes to show how much pull mega cap stocks actually have in the market to right now. Meta platforms, it'll be a big pull on mega caps and the market tomorrow. So Alphabet, it was down 9.6% today. Microsoft down 7.7% today. At the close yesterday in the after hours, they were both down just over 5%, both of them. So should have been on me to realize that investors would have freaked out a little bit, and they did. And that's why Alphabet lost nearly 10% today. Microsoft lost 7.7% today. Now, they did lead the downside charge following their earnings report from yesterday in the after hours. Yet worries about what may happen, what may come for Apple. And let me go back to the daily chart here. Apple was down 2% today. Apple is a big time mover in technology and ETFs. There are a ton of companies, a ton of ETFs that hold Alphabet, that hold Microsoft, that hold Apple. And they were just pulled apart today. And then, of course, what's going to happen with Amazon later this week, right? They were down 4.1% today. So they do report later this week. And right now, investors are worried about that. These big mega cap names, they completely undercut because they are heavily weighted and they are widely held stocks in many ETFs. And Meta Platforms in their reporting after the hours today, that is just going to be another bad news thrown into the basket with these other mega cap, heavily weighted, heavily held stocks. Now, the Dow Jones, it was able to close just a whisker above the flat line. The DIA is the ticker symbol for tracking the Dow Jones or for trading the Dow Jones. It was down 0.03%. That's flat in my book. Why did the Dow Jones hold up so well? Well, it was mainly earnings driven. Like I said on Monday's live stream and even yesterday, this week is all about earnings. That's what this week is about. So we had Visa, which is in the Dow. It had some decent earnings. People are using credit cards, right? The consumer's weakening right now, so they have to go into debt. Visa was up 4.6% on the day. That helped to raise up the Dow Jones. Index level gains were limited, however, due to a big loss in Boeing. Boeing down 8.8% today. That's another big one that held the market down today. The company reported disappointing quarterly results, and it said that its path to recovery, it's taking longer than expected. And it's driven by the challenging macroeconomic environment. Supply chain constraints also had a big impact on production in both its commercial and defense businesses. There was this underlying strength into market in today's market too. So don't just throw it all out the window for today. The Invesco S&P 500 equal weight ETF, ticker symbol is RSP. It showed that there was some underlying strength in the market with its 0.2% gain. Also, advancers led decliners by a roughly 4-to-1 margin at both the New York Stock Exchange and the NASDAQ. That also shows that there was some underlying strength in the market. It was just today was knocked out by those mega cap stocks. They took the entire market down with it. Now, factors supporting the broader market today included favorable quarterly earnings from names like Harley-Davidson, up 12.6%, Bristol Myers, up 2.3%, and a growing belief that the Fed will soften its approach after the November meeting. And there was also the pullback in treasury markets. Oh my goodness, we got to talk about that too. And then I'll throw up the dollar too. US 10Y for the 10-year. The 10-year fell 9 basis points to 4.02%. Look at this decline in the 10-year. This should have been good for the market. This should have been a good sign for the SPX, for the SPY, for the Qs, for the IWM, even though the IWM did actually hold up pretty well today, up 0.5%. But My point is the 10-year fell. The 10-year came down. The 2-year even came down. Look at the 2-year, US02Y. The 2-year came down 4 basis points to 4.42%. Let it load. Look at that decline there. It's been coming down. It's been coming off that resistance line up there. And then the dollar. Wait till you see this. All 3 of these charts in a row right here. All 3 of these charts should have led the SPX, the SPY, the Qs, all to gains today. It should have. But since the mega cap growth companies like Alphabet, Microsoft, Apple, now Meta Platforms are all losing big, those are the handful of stocks that all year have been directional drivers for this market. And they pulled this market down and held this market back. If it wasn't for the dollar being down so big today, the treasury market being down so big today, the losses from the SPY, the IWM, SPX, even the Qs, this could have been a 5% drop just today if it wasn't for the underlying strength in the market. So don't let these big mega cap names fool you. They were the directional drivers of this market, and it would have been way worse if it wasn't for the underlying strength. Now, this dollar, it fell a full 1.08%. That is a big drop in the dollar. You typically don't, on average, see moves of 1% or greater in the dollar. All right. So this was a big move down, breaking down that triangle pattern there. And let's see what it does tomorrow. Right now, if we draw this back and look at this, okay, we may have potentially seen a peak in the dollar. And the only reason I'm saying that now, we can go all the way back and you can watch live streams going back to July of this year when other people were calling for, hey, this is the top in the dollar. I was saying, no way. This dollar is still making higher highs and higher lows. Until that pattern breaks, the dollar is going to keep rising, and that's exactly what it did. But now, look here. Let me get my highlighter out. If you line up this low right here, which was a higher low from here, this is a lower low. This is a lower low. And a breakdown of its 50-day moving average. Remember in yesterday's live stream, I talked about this and I showed you how the 50-day moving average for nearly the entire year, going back to February all the way up to yesterday, the 50-day moving average has always been an area that it has bounced from, except for one time. And that was right here at the middle of August. For 3 sessions, it was below that 50-day moving average. Is that what we're going to see here? The one thing interesting about this compared to the last time it broke down under its 50-day moving average is even though it broke down, it still made a higher low. We do not have a higher low right here. This is a lower low. If the dollar is getting to turn itself around and head down, this is good for equities. Okay? And this is what could be the beginning of that historical pattern that I told you about earlier for the NASDAQ, and how November, I believe it is, now I can't remember now I can't remember. Let me look here. Give me a quick second. I think I have it here somewhere. Yes. November being the best month for the NASDAQ and the Qs for midterm election years. The past, or the NASDAQ has been up 8 of the last 12 Novembers with an average gain of 3.5% during mid-term election years. So it's not just the last 12 years, it's the last 12 midterm election years. The NASDAQ is green 8 of the last 12 midterm election years with an average gain of 3.5%. That historical data, the dollar falling today, the treasury market falling today, those could be good signs for equities. Okay? And those could be good signs for the Qs and for the NASDAQ and for the overall market. Okay? But we do have a little rough patch that we're going through right now with those big mega cap stocks. All right? All right, let's keep moving here. Half, as I clean this chart up here, half of the 11 S&P 500 sectors, they did close with gains today, led by energy, XLE. Energy was up 1.4% today. Again, it's just been a massive runner for weeks now, for a couple weeks. All of October, we had a little slowdown period, a little piece of consolidation here, but this thing has just been running rapidly. Why? Because oil prices have been moving up. Oil prices have been rising. Look at oil, USOIL, US oil on TradingView. There is a link in the description. If you don't have a free account yet, you can sign up for a free account. Oil futures were up 3.4% to $87.86 a barrel. We've been talking this support around $82, $83 a barrel up to this green line, which the bottom starts at about $88 a barrel. Nice big move here for oil today. That helped to boost your energy sector. All right. Now, the communication services sector, XLY, that was your worst performing sector today. Mainly due, and it was down, what is this, 4.8 or so percent? Let me see here. 0.8%. My apologies. But it was the worst performer by a wide margin, largely due to Alphabet and Meta Platforms. Information technology, XLK, it was down. It was another one of those laggers, and I don't have to tell you why. It's because of those mega cap technology names. They are components in the technology sector, and that's what helped to pull it down to big losses on the day. Now, there was a limiting factor in the technology sector that kept it from sinking any further than it did. That was Enphase, ENPH. This is one I've been talking about for years now. There's 2-year-old videos on Enphase on this YouTube channel. It's one of the companies that I have loved investing in. I've loved owning. I love the company. It shot up over 10, nearly 10%, almost over 10%, almost over 10% today on good earnings yesterday. So it was an earnings winner. Really, really good. And it showed solid growth in Europe. Visa, it was also, like I said earlier, it was a good winner today. So there were some winners in this market. Now, you had your small and mid-cap stocks. They fared a whole lot better than everything else. You had your IWM up 0.5%. The S&P mid-cap 400 up 0.2%. So there was a few sections that were green today. Now, the IWM, it was able to close above its 50-day moving average. And I said, if you want, I think I said this on Monday, and I might have reiterated it yesterday, but if you want this rally to continue, okay, if you want to see this rally continue to go up, then you want to see small caps go up. Because small caps, that's where all the short squeezes happen. That's where the riskier companies are. They're in the IWM. So if this market is taking a more risk-on approach, then you're going to see the Russell 2000, the IWM, you're going to see those indices, the S&P Mid-Cap 400, you're going to see those rise. And they're going to be some of the more aggressive risers, okay? And you're going to want to see those go up if you want this rally to continue, because we need risk on for this rally. Now, if we go back here to the SPX, if this is a true risk on and we are going to rally, even with the hiccup today, because remember, I talked about, I showed you where there was some underlying strength in today's market, even though it was down today. Where could we be going? Where could the end target be? I've talked about it before, but there is a mark, on this chart, and it is this red line right here, okay? I had to adjust it just slightly last night when I was looking over the charts. This was at 41.50. I brought it down to 41.15. If this is a true bear market rally, and we're finally just seeing the hiccup after 3 aggressive days, where we could potentially just move sideways here. I stressed it yesterday that we could be at that point where we move sideways for a few sessions. But if this rally does have legs, and it's not just the past 3 sessions, or the past 3 out of 4 sessions now, I should say. But if we're really going to rally from the October 13 intraday low, and we're going to rally up, where are we going? 41.15. That would be my target, 41.15. Okay? And this red trend line that's coming down from here, all right, that's going to be our lid for this, okay? That's where the summer rally got caught up, and that's where the March rally got caught up. And if we just extend this trend line out right here, even if we do have to angle it down just a little bit more, that's okay. This is a really nice trend line. Then that's going to match up right here at about that 41.15 area before we really have to hit the brakes, right? Like the summer rally. So that's where I think the SPX could be going. That's about 410 for the SPY. It's not a bad call, right? 410 for the SPY. I'll have to go over and look at where the Qs and the IWM, where that puts them. But at least for the SPX and for the SPY, 41.15 for the SPX and about 410 for the SPY. All right, looking at some of the economic data that came out today, there was some about the housing market. We got the MBA Mortgage Application Index. It was down another week in a row, this time 1.7%. It was down 4.5% last week, so just steady dropping week after week. We got September new home sales. The number came in at 603,000. The expectation was only 575,000. The prior reading was revised to 677,000 from 685,000. I know I'm throwing out a bunch of numbers here. The two numbers to really pay attention to is the revised last reading of 677,000 to this time 603,000. The key takeaway here is that it reflects how the spike in mortgage rates has created affordability pressures for lower income buyers. The jump in median and average selling prices was a bit skewed by higher priced homes accounting for a larger percentage of total new homes sold. So do keep that in mind. Now, ahead of Thursday's open, we get Comcast, Anheuser-Busch, Caterpillar, Merck, Northrop Grumman, Honeywell, AutoNation, McDonald's, MasterCard, the list can go on. We've got a lot of earnings this week. Those are just a few tomorrow morning. And then as far as economic data goes, tomorrow we get our advanced Q3 GDP report. The expectation, surprisingly, is a positive 2.3%. That's growth in GDP for Q3. Now, the prior reading, remember, was a negative 0.6%, and Q2 was our second negative GDP reading in a row, which is a technical recession. But since unemployment is still too low, it was just a paper recession we were in. The real recession will be next year. Maybe Q1, Q2, or Q3 of next year. I think that's when the you can't argue it's a recession is actually hitting. Now, we also get the weekly initial claims. The expectation is 220,000. Last week was 214,000. And continuing claims. The prior reading was 1.385 million. Then, another one to pay attention to is the September durable orders. The expectation is a positive 0.6%. The prior reading was a negative 0.2%. And durable orders X transportation. You take transportation out of those durable orders, and the expectation is 0.2%, exactly where it was last reading, 0.2%. How hard do rate hikes hit? How hard do rate hike? How hard do they hit? In what manner? Hit the stock market, housing, because we were just talking about housing and the interest rates. Can you give me a little more context with that question and where we're referring that to? When they actually hit. They actually hit immediately. They hit immediately when the Fed funds rate goes up. If you were ever to work at a bank, everyone always talks about how it's a lag effect. I'm going to talk about it. There's two ways here. And let me I'll leave this up. How hard do rate hikes hit? When do they hit? I'll add to that. The overall economy, everyone talks about the lag effect. Okay, let's talk about this. If you work at a bank where you do personal loans or loans for boats or loans for cars, right, at a car dealership, when the Fed hikes the Fed funds rate, all right, that rate hike is felt immediately. Banks will immediately send out to all of their partners. For example, let's take an auto dealership. A bank will send the Fed hikes interest rates, right? So the Fed funds rate goes up. Okay. Let's see here. I got to get my cursor back over. All right, let's just clear that up real quick. All right. I believe that I can get to it in TradingView. Okay. We don't need these moving averages right now, so we could just hide those. And we don't need that other stuff. Oops. Okay, this is the Fed funds rate right here. Okay. All right, let me just double click now. Okay, so this rate hike that we have from the Fed, basically going from 0%, okay? 2022, our first one hit right here, and this is February of 2022. And then it has just been nearly a straight line up to this top, okay? So this is the effective federal funds rate, the Fed funds rate. Now, when the Fed comes out and does a rate hike, okay, banks are immediately, either sometimes the same day, at the very least, the very next day, they are sending out, and we're using this auto dealership that does auto financing, for example. They immediately send out an interest rate sheet, let's just call it, to that dealership. Okay. So when they are then doing a loan for that vehicle, if somebody was here today and they bought a car, and let's just say it was down here 0%, it was in February, 0%, and then we get to, let's go a couple months later. Let's see here. I'm trying to keep even numbers. Let's see. All right, let's say then we're going to May. So in February, somebody walks in, they buy a vehicle, they can get 0% down, okay? Now, it's possible that since the Fed funds rate was basically at 0, it was technically at 0 to 0.25%. That would have been the Fed funds rate. So then the bank, since it borrows short term and it lends out long term, may have had a 0% for really good customers with really great credit scores. Maybe everyone else, maybe they had to pay, 2%, maybe 3% to 5%, you know, just depending on the credit. There's a lot of moving parts. So now that person who in February could get 0%, they go in today, maybe that person, excellent credit, maybe they're looking at a 7% rate, something crazy. Or maybe they could, you know, get it as good as 5%. Let's just keep an even number, 5%. 0% in February. Now today it's 5% because the Fed funds rate has gone up. Now, the Fed is about to, on November the 2nd, raise rates by 75 basis points, okay? Which is going to take us awfully high to 4%. Or I'm trying to use actual rates in telling this story, but I'm just confusing my own self. So let me take a step back. Let's just make up rates. We'll still use big numbers because it's jumped up really quick here. You walk into the car dealership in February. You can get 0% when you buy that car. 0 down, 0% financing. All right, good. Now, the Fed funds rate jumped up to 2% in March, the very next month. We had a big Fed funds rate hike. So now that person, they go to trade in that car. They don't like it. They want to trade in for something different just a month later. I don't know why they would. That doesn't make very much financial sense, but let's just stick to that so we can keep this story moving. Now, they see that, oh, they can't get 0% anymore because interest rates have gone up. Well, as soon as the Fed funds rate went up, banks sent out to that dealership an interest rate notice that said, hey, interest rates just went up because the banks are reacting off of what the Fed just did. Okay? All right. So now that person, well, just a month ago, I could get 0%. Well, why can't I get 0% anymore? Well, that's because the Fed hiked interest rates. So now banks don't offer that 0% anymore. Okay. So now he's got to pay 2% for that interest rate. That's where what the Fed does with interest rate hikes are felt immediately. Okay. Borrowing of that money overnight became more expensive. That's why when the Fed hikes rates and the market is not expecting it, the market sells off because it's instant. But that borrowed money, right, that the bank paid that dealership who originated that loan, well, the bank doesn't get repaid instantly. So the bank does not get the interest rate increase overnight paid back to them. Does that make sense? That is the portion of this story for why people say there is a lag effect and why some were concerned that the Fed was going to hike rates until something broke, right? Because when they hike rates, sometimes there is a little bit of time that has to go by before those rates are fully felt. So if the Fed continued to hike rates, now that person in February who could get a 0% loan, then in March they can't get that anymore. They have to take a 2% on their loan, their 2% interest rate. Now, in April, it's 4%. So now they come back a month later. Hey, I want to trade in my car for something new. Well, last month, it was a 2% interest rate. Now it's a 4%. Whoa, what do you mean 4%? Again, loaning the money, that interest rate was felt immediately. But the repaying of that loan took its time. Now, what else happens in the market when the Fed hikes rates? Short-term lending becomes more expensive. The 2-year is what we need to look at for that. So US 02Y. And I hope this story is a little more understandable this time around when I'm using made-up rates and not trying to stick to the actual rates that we have. So now, it's been 2 months. February, then March, now April. 2 months ago, this person could get an auto loan for 0%. Now, getting an auto loan is at 4%. So that's felt immediately on the lending of that money. But the repaying of that money, that's not felt until sometime down the line. That's not felt instantly. And the 2-year yield, this is something that goes up nearly as quickly as the Fed funds rate goes up. That's why if you look at this, it's been going up and up and up. The bigger the rate hike, the bigger this thing has taken off, or the more this thing has taken off, and the bigger moves that have been made. Now that the Fed seems to be wanting to signal a slowdown in rate hikes, we're having a bit of a pullback in the 2-year yield. Okay? However, if the Fed didn't try to signal that they were going to slow down their rate hikes, the 2-year would still be going up. So the way to look at this is when the Fed hikes rates, it's felt instantly on money that is borrowed. But it's not felt until months or years later when that money is being repaid. Because now, and the reason for that, the auto dealer who did a loan for 2% in March, just going back to our story there, and then the very next month in April, it's now 4%. It's not 2% anymore. Well, the money has already been lent out at 2%. Okay? Nothing can be done about that. But now the rate is up to 4%. So now every new loan is going to be issued at that 4% interest rate. Now, the interest rate could be up to 10%. But that's not felt for months, if not years later. First, that 2% interest rate loan, that will get paid off a month later. The 4% interest rate loan will be paid off a month later. And again, it depends on, how long are these loans? Are they 36-month, 48-month? What are they? So that money coming in over time with that lower interest rate will continue to go up and up and up and up and up as long as the Fed hikes rates. So if a year later the Fed has hiked rates substantially, say 10%, using made-up numbers, But a year ago, money was being borrowed at 0%. That bank is having trouble maintaining that balance sheet. And again, I'm keeping this overly simplified. That bank is having trouble keeping that balance sheet because a year ago, the cost of borrowing money was at 0%. Today, a year later, the cost of borrowing money is at 10%. So the bank doesn't get that back until months, if not years later. At that point, we don't fully see or feel showing up in the balance sheets of these banks or the balance sheet at the Fed for months to years later, because we don't get that money back until that money's repaid with that interest rate being repaid with it. So that's how interest rates have an immediate effect on the cost of borrowing money, while the stock market goes down when rate hikes go up, and why banks immediately send out interest rate increases to their loan originators, their partners. But then as the money is being paid back and as it starts to show up on balance sheets, then it is really felt. Money is created when it's borrowed, okay? Money is not created when the loan is paid back. So the money doesn't show up on the balance sheet until it's paid back. That's the simplest way that I can kind of explain why interest rate has a immediate effect, but can also have a lagging effect. Because when the money is lent out, that money is being created. When the money is repaid, that's when it's actually showing up on the balance sheet. Our financial system is bonkers, confusing, overly difficult, because there's always somebody somewhere who is trying to work it in their favor. And that's what's got this mess that we have. All right, let me put the SPX up here. And I'm going to clean the screen off so it's only the candles. Give it just a second. Okay. I don't know if I can do this now. As a matter of fact, hiding everything. Let me see if I can. Okay. I want to put the... Let me see if I can put the 2-year. Okay. All right. August is when things kind of disconnected here. All right. August is when the 2-year really started to take off. And let me go back a little bit further. I just want to get 2022 on here so you can see. I mean, I think I'm getting too far away. Yeah. the effect's not as dramatic there. How about here? All right. All right. So this goes back to May. And you can see that the 2-year yield, go figure. I thought I could do it, but I guess I can't. All right, I can't draw on it, but starting back here all the way to the left of the chart, the 2-year was actually going down a little bit here in the month of May. The SPX was going down with it. Then the 2-year shot off. It just blasted off. The S&P, it came down. Then there was this choppy period through August when we were having our summer rally, but the 2-year was making higher lows and it was making higher highs, but it was very choppy along the way. And then we got to the middle of August, where from that point on to literally the middle of October, the 2-year was taking off like crazy and the S&P 500 was declining like crazy. That's showing you the instant effect of the Fed hiking rates, interest rates going up, the cost of borrowing money immediately having an impact. And then the middle of October, we started seeing a pullback in the 2-year, and we started seeing a rally in the S&P 500. Now, what took place back here when interest rates were first started going up, that's not going to show up on the balance sheet until maybe next year. Maybe Q2 of next year. Maybe it is exactly 1 year later. That's the delayed effect. When the money shows up on the balance sheet. And that's as oversimplified, but it's the easiest way that I know how to explain it. So the cost of borrowing money goes up quickly, almost instantly. But then it's not felt on the balance sheet until months to years later. And that's the lagging effect. So hopefully that made sense. It took me a long time to get to the simplest form of what happens and why it happens. So hopefully I didn't bore you too much in getting there. And hopefully that makes sense. Because honestly, I don't know how else to explain it. All right, let me get this crazy chart back up. All right, so tomorrow, Thursday, we talked about what we have. We've got earnings. We've got Q3 GDP, the first reading, because we get 3 readings of that. We get the first reading for Q3 GDP. The expectation is a positive number. If it shows up with a negative number, then that's not going to be good for the market. That will move the market. We also have the aftermath of Meta Platforms' earnings report that we'll have to deal with tomorrow. We could see continued pressure due to mega caps being a pivotal directional driver in the market tomorrow. But remember, there was underlying strength in the market, and that's what kept us from being clobbered today. Small caps were green. IWM was up 0.5%. That underlying strength in this market, as soon as the mega cap narrative changes, as soon as Apple reports, as soon as Amazon reports, as soon as, if one of those two is positive, that could be a benefit to kind of slowing down the market. Not slowing down the market, to slowing down the slide in mega caps. Too much relative strength and weakness everywhere. That's where I'm having trouble trading. Good point. Good point. Earlier, well, maybe it was, I don't know if I talked about it on Monday during the live stream, or if it was towards the end of last week or sometime last week. But I was talking about this, what you're mentioning here, too much relative strength, too much relative weakness everywhere. This is a hard market to trade. And the only way to be successful with it, I'm going to go to the 5-minute chart here right quick. I say all the time to be patient. Use small position sizes. Well, this morning, right? This morning there was a gap down first thing this morning. We moved sideways and then we started to rally. We reached yesterday's closing high or yesterday's high and we passed it. That could have been a sign that, oh, well, you know what? It looks like today we're going to rally. So being patient, well, shoot, that just didn't work. Because by lunchtime, Eastern time that was, the market started selling off. So being patient and waiting, that didn't work out. This is an extremely hard market to trade, especially for those new to trading this environment. And there are so many who are. The past several days have been excellent, minus today. But there were positive signs in this market. If the, and one other thing to note too, and I say it quite frequently, no one's got a crystal ball. No one can see what's going to happen tomorrow, the next day, or even a week from now. The market is so jittery right now and is on so many pins and needles. So much money is sitting on the sideline that it doesn't take much to move this market. What I would suggest is make sure that when you are trading, any news article, analyst on CNBC can move the market. It's frustrating. It is. It is very frustrating. I feel you on that one. It is hard. The only thing that I can say is that you're not alone in that. There are many, many, many investors who are learning for the first time what volatility is like. and it's difficult, to say the least. You have to use small position sizing, and like when you make a trade, you need to be doing it with like 1-2% of your total capital. They have to be small, and they have to be tactical. Okay? Only go into a trade if you see a setup. If you don't see the setup, don't go. Don't do it. Okay? Wait for that setup to come to you. The tickers that we send out, some of the better ones to look at are the pullback longs and the pullback shorts. Because if you're looking for taking a long position, those pullback longs are the best option. If you're looking for a short position, those pullback shorts, those are the better ones to go with. Let's go over here. I'm going to go over here to Netflix for a moment. All right, let's see here. Netflix this week has been crazy. Even today, up 2.6%. This has been a relative strength winner this week so far. It's been a good one. Let me go over here to ExxonMobil. It was up 1.2% today. Okay. This one had a pullback going on Tuesday. Midday Tuesday, when oil turned around, this turned around. And it had a decent day today, 1.2%. This has been a relative strength winner as well. CVX, which is Chevron, it's also been a relative strength winner. It was up 1.2% today. This one didn't have that same pullback on Monday that ExxonMobil had, but this has been a winner for this week. Those are some of the momentum plays for this week. If we go over here, let's see. Hold on just a second. All right, come on. It's taking a minute to load. Oh, come on. Come on and load. Okay, let's see. There we go. Okay, let's go over here. Semiconductors were down today, but they've been marching pretty strong. See, this is where this is has had really good relative strength. Again, this is the 5-minute chart. Had a big whipsaw day last Thursday, but Friday, Monday, Tuesday, good days. And then to the top of today, really, really good as well. Again, you can see the momentum, and that's the Van Erik Semiconductor ETF. Let's see, what else do we have here? Let's see. I haven't looked at Deere in a little bit, but it was, or I should say, Deere has been on our momentum stock list for a little while. And man, that thing really had some nice momentum going into this week. But Deere was on our momentum stock list last week. Caterpillar could affect Deere tomorrow. Let's see. STX, which is Seagate Tech. That one had a big drop on earnings. But right before earnings, this thing was on a relative strength ride. But today, that lost it. That thing was down hard today. Let's see. Let's see. Ticker symbol PBF. It recently had a pullback, but it's had some relative strength here. I guess I should stop saying that word relative, huh? Let's go back to the daily. This one was up 4% today. This is when I mentioned the pullback longs. This was on our pullback long list today, up 4%. This one was down 0.25% today, but it came into an area of support. It was down much more. This is S-ARC, which is the short ARC innovation fund. And you can see it's been having some, it's volatile, but from that August low, this thing has been moving up nicely, but it did have a little turnaround. So this is on the pullback long as a candidate. And then TSLQ, which is the Tesla Bear ETF. it's on the pullback long list as well. And you can see this thing just, most of October, this thing just ripped big time. So this is, if you want to go bearish on Tesla, this is that one, but that was down 1%. If you're looking at pullback short candidates, steel, NEE, and energy are obviously on there. So this is one that you could be shorting. It has had a decent pull over the past little bit, but this thing has been coming down. This is on the pullback shorts. Let's see. XLY, which is one of your sectors there for discretionary, is also on it. It has been an overall downtrend, except for, of course, recent momentum. So these are some pullback shorts, which means they have been in a correction territory, but they have been overall pretty darn bearish on the year. If you're looking for stocks that have been running high, hot, SPLX, which is your leveraged bull run. Of course, it was down a little bit today, but this thing has been running pretty hot. If this market wants to continue to run and go up to where this line is right here, this thing could go from maybe 64 to 84. If that rally continues on the S&P 500 up to that 4115 area. So that's a potential one for you. I'm just kind of going over the stocks that I've been trading, just to kind of throw out some ideas there. Let's see here. Let's see, how about ticker symbol CAR, C-A-R, which is Avis Budget. This is one that's overbought. This is one I'm looking to short right here. It's had a big run up, and its earnings report is about a week away. So this up here, the red line at the top, that is a very strong resistance point up there, and that's at 330. What is that at? 327. So this red shaded area, it gets there, and I'll be looking to short this one. Again, it's up in this red shaded area up here. So that thing's been running hot. Let's see, who else is overbought territory? HAL is the ticker. I'm just trying to throw out some ideas here. So for this one, the red line up top, this is a pretty strong resistance. This is an expensive one. It's at 2503 is where it closed today, and yep, that's 2,000. But up here at 2641, that's kind of looking to build into a short position for that. Even though it's been a pretty nice performer. And again, it's about 2 weeks away from its own earnings report. But it could go up and test that, and that could end up being a potential double top there. What about oversold that could potentially be heading? What about ZTO? This would be on the oversold list, looking to catch a bid. It's had 2 decent days after a pretty substantial drop off, and it's nowhere near earnings yet. 6.7% today, upside move, 4.8% yesterday, but that is coming off of a pretty substantial move down, 21.6%. So that's a pretty far. And when stocks drop like this, typically you can see pretty strong bounce back up to that 5-day EMA, depending on some of the context, but this got just really oversold. Really oversold. Okay, let's see. Okay, how about this one right here, XP? Sometimes you want to find stocks that are coiling up, that have got a really tight consolidation pattern going on. Those are ones that could potentially, you could catch for a ride. So this one has got this top up here and this, bottom down here, and it's kind of been bouncing around while it's been making these lower lows. So maybe this one could potentially be catching a bid here shortly and riding back up, maybe. But it got hit today because of the technology situation. So how about let's see, what's another one that I could throw up here? AKUS as the ticker. I mean, this thing just launched into the stratosphere a few days ago, and it's been coiling up ever since. But what was this original? It was down 10%, down 5%, and then it popped 88%. Let's see. AVEO would be another ticker. A pharmaceutical play here. Another big pop there. So this is one that could potentially be setting up for a short position, because usually the stronger they go up, the stronger they fall, right? And what did this one ended up popping at? 42%. Just crazy. All right. So just a few tickers there that been watching. Let's see here. You're absolutely welcome. Let's see. Yeah, today's semis were ripping, even though Texas Instruments did bad on earnings. I'm just lost sometimes. Yeah, I can feel that. It can definitely feel overwhelming. Where do I go? I mean, you've got thousands and thousands of choices that you could make in this market, and making the wrong call can just feel horrible. But nobody having a crystal ball. What I would say about the rally that we're in right now, I think this rally can continue. It may pause here for a little bit, but I think continuing up to that 41.15 for the S&P 500, I think is reasonable. 410 for the SPY, I think that's reasonable. It's going to take a little while to get there. And this is a very volatile market. The volatility makes things very hard. So seeing volatility go down, maybe that's more of a better play. But keep those stop losses tight. Really tight. Use small position sizes. Right now with volatility high, don't go in with more than 1-2% of your portfolio in any given trade. Keep it small. Because remember, when volatility goes up, you don't have to trade as much and able to make make as much. I've used it before in thinking that if you're used to volatility being 15-12%, or points, not percent, and $100,000 account, well, when volatility gets into the 30s, that's like trading with a $200,000 account. That's what volatility does. So you have to be real careful with that volatility. Let's see here. Let's see here. There was one more thing. You're welcome. I usually talk about those every once in a while, maybe every couple of weeks. I'm just looking here right quick. Let's see here. All right. Okay, well, I guess I'll wrap the live stream up here. I've got in everything I wanted to talk about. I talked about a few of the stocks that I've been looking at. I'm just looking through any of the other tickers if there's anything significant here. Even with today's move, like this 3/4% move down in the SPY, there's still a greater chance of this thing moving sideways to moving down, I think, for tomorrow, especially with Meta and with the kind of pull down of technology today. And with this thing tagging that upper weekly expected move and then coming off of that, let's get those moving averages back up here. Couldn't hold above that 50-day moving average. That's just, to me, sign that this thing might just want to move sideways for a mile. We do have this line right here for the SPY. It could be an area to look out for to bounce. It's where the 5-day EMA is. It's at 378. So if the SPY wants to pull back again tomorrow, look for 378 as a potential area where it could bounce. Remember that 5-day EMA, these candles like to stay connected to it. And whenever they get off of them, look for them to pull back to them, or if they've been down, look for them to pop up and make their move back up to them. And it doesn't have to always be just the candle. It could solely be the wick of the candle that connects with that 5-day EMA. So right now on the SPY, the candle, the wick, it is off of that 5-day EMA. Again, that's 378, and it's at 382 where it closed. So watch for it to pull back to that and potentially be an area where it might bounce, but it doesn't have to. But I think it does need to reconnect with it. You are welcome. Absolutely. That's a really good point right there. I got to stop hyper-focusing large caps only. That's a really good point. Excellent point. There are, like I mentioned just a few, sorry for bumping that thing. There's thousands of choices, thousands of stocks out there. When the market has low volatility and the channels are clear cut, like if we're in a trading channel where it goes up, it tags the top, it comes down, tags the bottom, and it keeps doing that, and it's either moving steadily up or steadily down, much tighter than this little trading channel that we've had this year, trading the mega caps, that's perfectly fine, right? Let me just do this and then I'll wrap up the live stream. If we just get 2022 out of our minds for just a moment and go back to 2021, which is what I have on the chart here, I mean, you can see trading in the mega caps, it's pretty easy. There's a solid trading channel all the way up as the chart goes up and to the right. So when it pulls back to that 50-day moving average, you buy the dip and then it rallies. And then you just rinse and repeat. Buy the dip every time it tags that 50-day moving average and you're golden. It's really easy to trade in a bull market. Trading in a bear market, however, when volatility increases, that's when it's the most difficult. And that's why so many investors have just completely left the market right now, and why there's a record level of cash sitting on the sidelines. It's because this can be too hard. But there's always some way to play it. Just being strategic, keeping that risk as your number one focus. Don't matter what you're trading, right? Keep risk clear as you can and keep that under control. Like I do believe I said this on Monday. The number one critical goal right now is capital preservation. Now that this market has started to swing higher, it's not so easy to short anymore. And now that we've kind of reached this 50-day moving average for the S&P 500, it's not so easy to go long right now or short right now because it could literally go any way. This week has been all about earnings, and one of the biggest unpredicting measures out there is earnings. You can feel like you have the complete lockdown on earnings, on what this company is going to do. And it can just rug pull you and completely surprise you and leave you thinking, what did I just do? So we've got high volatility. Earnings are the big focus this week. So capital preservation is key this week. Only trade the setups you feel comfortable trading. Don't try to increase risk because volatility increase risk for you. I like trading Tesla volatility first thing in the morning. If things look like a potential up move, I like to be done within 90 minutes. Yeah, a lot of the big moves, they happen within the first couple hours of the day. And the first, hour or so of the day can really determine which way the market's going to go. Today it didn't for the S&P 500, but for others it did. Last three scalps. Yeah, scalping is another thing that can work with volatility. Definitely. We're positive, but I've done none this week because the slow moves upward did not give me a signal. Yeah, that's good. That's good. That's good that you've got your strategy and that you're sticking to it there. I prefer trading up and down channels. I do too. I love channels with long trends. Made it in 4 weeks buying bottoms, selling tops. Yeah, it can definitely be done. Absolutely. Absolutely. All right, well, I'm going to go ahead and wrap the live stream up for tonight. We've been going for, oh my gosh, 2 hours. Holy moly. But hopefully, I knew I needed to take a little extra time tonight. I know it can be difficult. Just keep your risk under control. Don't force yourself to take a trade that you don't feel comfortable about. Just sit back, pass on it. You don't have to trade it. Okay? Earnings, they're a volatile time. Earnings season is a volatile time. We have high volatility. Those two just create even more volatile times in the market, right? And when you're unsure, that can be, boom, it can wipe you out very quick. So don't trade unless you feel like this is going your way. You have some sort of a signal telling you that this is the trade to make, and then go after it. Make the trade. But if it's not there, if the setup's not there, then don't do it. You are welcome. You're welcome. This live stream's for you. It's the only reason I show up is for all of you. So I'll wrap it up here. Thank you guys and gals so very much. I greatly appreciate it. If you need to take a day off from trading, do it. You don't have to trade every day. You don't have to increase risk when risk is already out there. So, all right. Well, I'll wrap it up for tonight. I greatly appreciate each and every one of you. Thank you for hanging out with me tonight. I know it was a little bit different, but I felt like I needed to do it. So we did it. And I'll see you back here tomorrow to talk about what happened in the market, why it happened, and what to expect going forward. The best that we can all do, right? All right. Thank you, ladies and gentlemen. I'll see you tomorrow. And Have yourself a wonderful evening. Take care.